self-builds
Yep.
and hiring a general contractor. So at Dart Bank, we do require a licensed general contractor to oversee the entire project. So I will get some people that ask me like, hey, can I have 2, 3, 4 licensed general contractors? And I have to say, no, I'm sorry, you can't, because then you're still acting as a general over the generals. So we do require a licensed contractor. We can delve into that a little deeper if we see some chats or questions come up. But that is something where if you call up and you say, John, I'm doing this all myself. By the way, I did that myself, so I get it. I understand the value. I also do know, now that I'm older and more experienced and been down that road, I also know the drawbacks for it and the reasons why banks don't lend on it because of the risks. So I'm going to transfer this kind of more over to Ben to answer these questions, because he's going to bring out some risk factors that Greenstone is, they're aware of, and that they're going to require for you if you are being in general. So Ben, do you want to address that for any of the folks that may be thinking about building it themselves?
Yeah. And if I kind of get going on different avenues here, just direct me back, maybe ask me a question. But
Sure.
There are two different ways to approach it. Number one is with a general contractor, like John said before, has to be licensed. What Greenstone allows for is do-it-yourself construction, commonly referred to as DIY. So the borrower gets to act as the general contractor, meaning that you do not have to have any licensing. But what you do need to understand is you need to be proficient in filling out a sworn statement, obtaining lien waivers, collecting all bids and estimates. You're acting as the general contractor, so there's going to be a lot of responsibility on your shoulders. You're going to have organization, access to things such as Microsoft Excel, because we do require sworn statements to be filled out in Excel format, for obvious reasons, such as the quick calculations it offers, as well as keeping you organized throughout the construction project. DIYs are great in the sense that it does save you money from having to pay that contractor. Adversely to that, I think sometimes it can take away from the experience for the borrowers, as to they have to have all that burden of facilitating the sworn statement, tracking down lien waivers, and making sure that they're monitoring the project as it goes along. Whereas these generals, they do this for a living. There's a reason why they get paid to do what they do, and it is a very added benefit. But if there's somebody who is knowledgeable enough and they know about the general contracting, maybe they have a brother, an in-law, or a close friend, that'd be an option to where they could bring them on as a trusted advisor, essentially. So it'd still be a DIY, do-it-yourself construction. So there's different ways to approach it. I don't know if that kind of...
Yeah, let me throw in some additional questions, I think, that maybe get you a little further into the weeds. Okay, so one of the things that I talk about when people come to me for being their own general, and because I still want to have discussions and try to be a guide for people. One big thing is what happens if you have budgeted very lightly on labor because you're going to paint or maybe do interior trim or even maybe the framing or roofing. Some folks want to do it all, but let's say there's specific line items. And I say to them, what happens if you get, hit by a bus? What if you fall off the roof? Now, all of a sudden, your project's at risk because you're sick, you're out of work, you can't get these things done, or you hired Uncle Joe to do it. Uncle Joe's got his full-time job or a gig he's doing. So I say, from a pragmatic standpoint, are you budgeting in a labor item so that you have what we in the banking world call contingency reserves to help cushion that in the event something goes south and you need that? So my question then, Ben, from a banker to banker, but to our general public in layman's terms, do you make folks go out and factor something in? In other words, do you require a contingency reserve on your self-builds?
Here's how we're proactive with that. We tell our borrowers, if you're going to be doing a do-it-yourself construction loan, meaning that you're facilitating the sworn statement, and you plan on doing the labor, whether you're doing some or all of it, you have to go and fully get bids and estimates for every line item in that sworn statement, as if you were not doing any of the labor, for the reason John alluded to previously. What happens if you get hurt? What happens if you're not able to do it? What happens if you simply don't want to do it and you want to contract it out? So you have to bid it out as if you were not doing it. So essentially, you got to qualify for a much higher loan amount on the front end. On the back end, you do labor throughout the construction. You're not going to be drawing as much from every time you request a draw. Let me just give you a quick example. You have flooring allocated, laying wood flooring down. and maybe you're utilizing Lowe's for the materials. It's $20,000 for the flooring, $10,000 for the labor. So you have $30,000 allocated to that line. When it comes time to take a draw and you've done the labor, you're only going to disperse $20,000 from the loan. At the end, when the loan has been fully dispersed, we'll do a one-time reamortization. So you earn equity as you go throughout the loan. And that is the biggest issue we see with DIY construction is when we get that sworn statement, we see what the total cost to build is. We divide it amongst the livable square footage, and we're looking at it, and we have a super low cost per square foot to build. We know right then and there, we want to see the bids and estimates to see if labor was added back into it. And maybe sometimes it is, but it's too low because we see these all the time. Our credit department analyzes them as well as I do. To add on to that, we do require a 10% contingency over the total cost of build. And that is for overruns during construction. So that's how we kind of mitigate that risk a little bit, during construction. And then we mitigate the risk up front by making sure the borrower obtains all bids and estimates. And then we take a deep dive into it too, to make sure that labor is accurately accounted for as best we can.
Perfect. So folks, just, again, from an interpreter standpoint, I think Ben did a really good job at keeping it baseline in layman's terms without banker jargon. But just as to kind of do a little quick summary. So what Ben's saying is if you're going to do this yourself, you've got to still go out, get those bids, put them together. And then on top of it, he's going to add an additional 10% to give the bank a little safety net as well as yourself for you. So what we're going to talk about, I got one more question for Ben. A lot of times I also see with self-builds, the issue is that, a homeowner has got their land paid for, their down payment's gone in up front because of, meeting our bank loan to value requirements. Now all of a sudden they don't have a lot of cash sitting in hand, and they need money to pay maybe a supplier up front or a subcontractor up front, or to put deposits on windows. I got, a deal right now. We had a kind of big check at closing for windows. So we're advancing some money out in front of a project being completed. How does that work for self-builds with you guys? Because I know that a lot of self-build people, they need access to those funds immediately. And traditionally, the way a bank works is a builder will do their work, they'll do an inspection, make sure work's done, then they'll get a check. So how does Greenstone handle that with self-builds?
So with self-builds, the earliest you can request a draw would be at closing. We're not going to advance any funds prior to closing. At closing is the earliest you can request a draw. So if you request a draw at closing, we could disperse those funds on that day. And then when you need the next draw, you'll be supplying lien waivers and paid receipts for the previous draw. So you're always working one draw behind. And we have 4 inspections throughout construction. So it's not like every time we disperse funds, we're going to go out there and inspect and see where those funds went to and what labor was completed. There's 4 inspections that are timely, and I can provide that information to customers who inquire, just the general populace that's following today. But generally, they're after the footers have been poured, and then you have 1 at rough end, 1 when the interior is complete, and then the last one is when the township issues the certificate of occupancy. We'll do our final inspection. But again, we do not advance any funds up front. And one thing to keep in mind too, for the borrowers out there, a lot of times, 20% down is pretty hefty along with your closing fees. However, the funds that you put down at closing is what's going to be used first in construction. That's one thing to keep in mind. And then I did want to make one point, John, real quick, if I could.
Yeah.
With that 10% contingency, and like I said, you got to qualify for a higher loan amount up front. And what I mean by that is, let's just say that once you add in the 10% contingency, you've gone out and fully bidded everything, and your total cost to build is $400,000. But in your mind, you're going to do all the labor. You don't think you're going to have to use any of the contingency funds, and you think you can build the home for $300,000. That's great, and I hope you do. But you got to qualify from an affordability standpoint previous at the $400,000. Even though we may end up finishing at the end with $300,000, then that's your mortgage amount because we do a one-time close. So I just wanted to throw that out there.
Perfect. Hey, Ben, so we do have a question, and this is a great question, actually, and I'm sure some people are thinking of this. So I've got a little note here that I want to come back to on affordability. And then so just really quick before Adam asked a question, and I'm going to go to that in a second. on the disbursement of funds. So just to reiterate, with Greenstone, if you are self-building, it does appear that Ben, and just correct me, you can advance funds. So if you're at closing and they need to get that, let's say a lumber package ordered, you can go to closing and disperse. Maybe that disbursement may be some of their own funds, but if they come short, you're gonna buckle up that other part of it. So let's just say a lumber package is 80 grand. They've got a $40,000 down payment. They cut a check for 40 at closing. You're going to make up that 40, even though the lumber hasn't hit the site. You guys are able to do that.
Yep. And then before they request their next draw, we'll just need that lien waiver, whether it's a partial or a full, before we're going to disperse any more funds.
Okay. So folks, that's a big deal. Okay. That's a real big deal if you're a self-contractor, because, if you need access to that money, there's not a lot of lenders out there in the country that will do that. So make sure that, if you're in that spot, you want to talk to Ben about the details. So that's a big deal for you. Okay, so let's go to Adam's question. So Adam's question is, what happens with the leftover money at the end if there is some? Do you have to take and make payments on it, or is it removed from the loan? And lower the overall price and payment. So at the end of construction, everything's wrapped up, and they had, let's talk about. Well, I can answer mine after you. Let's assume it's a self-build. For Adam, and he, had these contingency reserves, that extra money in there, and he's got, he saved himself 50 grand at the end.
Yep.
Tell Adam what happens to his money.
So you can either use it for more property improvements, specifically relating to our collateral. If you're going to be improving that property in any way, we can allow those funds to be utilized for that purpose. Ultimately, it has to be approved by our credit department. But if you're going to be utilizing it for property improvements, we can allow you to do that. Say at the end, you've got 50,000 left over, and you wanted to throw on, a small storage shed, or maybe pave your driveway, something like that. That'd be something we could approve it for. Or if you simply don't want to use it, then your loan amount is lowered, and then we'll do that. We'll reamortize it over the term that you agreed to in the interest rate at closing, and thus lowering your mortgage payment. So
yeah,
those are the two options.
So Adam, if that didn't answer your question, make sure you reply back in. But just to summarize, so in that case, if you had that extra 50 grand, it's going to go back on your mortgage. And if he had, if we had a payment projected, let's just say of $1,000, and that lower $50,000 drops it down to $750, then your end mortgage for the, whatever you're at, 20, 30 year mortgage, is at that lower $750 payment. Okay. We've got another question from Ashley. She says, hey guys, thanks for doing this. You're absolutely welcome. We love being servants to our clients. What are the criteria for financing, credit scores needed, and so on? As much information as you can provide in an umbrella statement.